So again, two major changes have been done in budget 2026, and one is the FIF regime. So if you know FIF regime, what it is we always had a threshold of $50,000 was, and I have done a lot of work in tax advisory in that FIF regime for over the years, and we always had a view that why this threshold is so low, and that hasn't been changed for years, even though $50,000 was quite a big money back then, but now it doesn't make much of a sense. Let's say you buy 1,000 shares in Tesla, and if one share price is $400, you can imagine 400 times 1,000. We're talking about $400,000 here. Even 100 shares will take you over $50,000 threshold. So that itself was a bit there was a lot of ambiguity in that. So good that they have lifted the threshold to 100,000. So FIF threshold has been lifted to $100,000. And one more thing they have done is revenue account method model. So the new migrant, this is something they did in last budget. They said that if new migrants are coming to the country and they are unlisted shares out there, those unlisted shares will be available for revenue account method, which means only realized gains will be taxable and only 70% of that would be taxable. And now what they're saying is this will be rolled out to everyone, even to those people who are New Zealand residents as well. I get a feeling, I think they have done this mainly for the new business visa, the investment plus visa, where they're asking for millions of dollars to be invested in the country. They want to make sure that those people not unintended linked into this FIF tax regime. So also might be able something to do with that as well. So there is a major change for FIF regime that's been done. Other big thing, the small businesses, my clients or other, if you are a business owner, will be affected is the fringe benefit tax. You might know that current fringe benefit rules are logbook method. You need to do 90 days of logbook, and you need to see kilometer travel to, from, and come to the percentage. And that percentage is used for the calculation of private use adjustments and FBT and those sort of stuff. Now they're moving away from them. They're looking at more modern approach, the more sensible approach. So what they're talking about, this is in here. So basically what they're saying is if it's a business vehicle, and there's a private availability, FBT calculation return file. So this is how FBT is being done. So the present vehicle rules often requires detailed tracking of a vehicle is available private use or not. So those sort of stuff is there. What they're changing is close enough. So to calculate FBT, we have to go to the logbook. What they're saying now is the close enough, the post-policy directions for practical compliance. So again, a lot of things will come down onto the taxpayer as a self-assessment tax system, that what do you think, where is the close enough approaches, and the onus of proof is always lie back onto the taxpayer, that how can I prove that close enough approach is yes close enough, so that I can demonstrate it to in the event of an tax audit. So current approach is count the private use availability days. A vehicle can create an FBT liability when it's available for an employee's private use. So the outcome can be technically correct but difficult and time consuming to administer. Commuting can still be private use unless a specific rule or category apply. Remember, if you're commuting to and from, it can still come into private use category, and FBT will apply. So the budget 2026 creating 6 categories, effectively 4 categories, but 4th category has 4A and 4B. Category number 1, full private use. Yes, if it is, okay, 100%, FBT will apply. Partial private use, then 35%, farm vehicle 35%, minor private use 20%, minor use 0%. So this is basically a category approach where based on the expected use, percentage of that will be taken out from the FBT calculations. So no need to do the day counting as a primary method. Category selected when the vehicle is provided, only reassess if expected private use changes materially. So these are the categories they have done. So basically this is inclusion rate is this. giving more practical approach to this plain English meaning. Category 1 meaning vehicle for private use. Okay, so category 1 is vehicle mainly for private use. It will be included 100% for FBT calculation because you're using the vehicle for private use. Category 2, vehicle mainly for business use. Private use allowed on non-work days and commuting, vehicle must be branded. So in that case, you need to pay FBT on 35% of that because I'm only using on non-work days and my vehicle is branded. And same thing, farm vehicle mainly for business and farming operation, private use allowed but not working. Okay, same thing, 35%. Business vehicle only private use is commuting to the same work site. Vehicle must be branded. In that case, 20%. Right? So this is my business vehicle, but I'm only going to and from work. So which means only 20% will be included. So which means is the value of the vehicle is $100,000. Only 20% will go into inclusion for purpose of FBT calculation. And as you know, if you know the FBT calculation, the inclusion of the vehicle becomes pretty important because that determines the FBT tax rate. And if it's purely a business vehicle, only private use is commuting where work requires travel across multiple work sites. Vehicle must be branded. In that case, it's 0%. So these are the rates. Now, how do you choose the category? It's a big complex thing, but very quickly, start with the main purpose, check what use is actually permitted, check whether branding is required, check commuting work site is multiple work site, document the decision and review if any changes. Basically, look at those things. Incidental use versus white matters. White matters reduces the logbook pressure, avoid category change for one-off events, support practical compliance. So this is the main thing here. And again, work-related vehicles exemption, emergency vehicle exemptions will always be there. This is again quite technical area, but here I tried to explain in very quickly what is done. So these were the changes mainly done for the taxation of 2020-26 budget and 2026 budget. These are the taxation changes were done. And just to recap, mainly we need to worry about the FIF, that 50,000 exemption has gone up to $100,000. So this is the major change. The revenue account method is available for the new migrants. So again, that's a major change. And also for the New Zealand taxpayers, that method is available. The second biggest thing is not-for-profit entities. So the threshold has gone up to $10,000 from $1,000. Again, that's a major change. And third is the FBT. So FBT, you don't have to worry about those logbook anymore. We can use the actual percentage method as opposed to the logbook method. And thank you for watching this video, and more videos like this. Please subscribe to our channel and support us. Thank you.